All right, welcome back to another explainer, where we take these super complex financial metrics and, well, make them actually make sense. Today, we're tackling what a lot of people consider the absolute holy grail of stock valuation. We are talking about earnings per share. If you've ever so much as glanced at a company's financial statement or tuned into an earnings call, you've definitely heard this term thrown around as the ultimate measure of success. But what is it actually telling us?
So let's just jump right in by asking the most fundamental question every single investor faces when they're looking to buy a stock. How do you know if a company is truly making money for you? I mean, sure, you can look at massive revenue numbers, but as we know, revenue absolutely does not equal profit. You can look at net income, but even net income doesn't tell you how much of that giant pie belongs to your specific slice of ownership.
The answer to that question is almost always earnings per share, or EPS. This metric simply tells you exactly how much of a company's profit belongs to each individual slice of the pie. It's basically a direct bridge between a company's massive corporate earnings and your personal portfolio.
Okay, here is our roadmap for this explainer. 1. The core of EPS. 2. Doing the math. 3. Peeling the layers. 4. The buyback illusion. And finally, 5. The negative earnings paradox.
Section 1. The core of EPS.
When you're trying to value massive multinational companies, looking at total billions in revenue or net income can be incredibly overwhelming. It is honestly just hard to contextualize $1 billion. But EPS is great because it boils that massive, abstract scale down to a single digestible number per share. It lets you track whether a company's profitability is actually growing on a per-shareholder basis over time. And consistent growth in this metric over, say, 3 to 5 years, that's widely considered a really strong signal of a healthy, robust business.
Section 2. Doing the math.
Okay, don't let the math scare you. Calculating this is actually way less intimidating than it sounds, and doing it yourself gives you a tremendous edge. The crucial point here is just a simple 3-step formula. You take the total net profit of the company, you subtract out any preferred dividends, because remember, those get paid out before common shareholders see a single dime. And then you divide that resulting number by the weighted average of common shares floating around in the market during that period.
To make this kind of fun, let's borrow a brilliant hypothetical from one of our sources. Imagine a company selling glow-in-the-dark toilet paper. You know, for those late-night trips to the bathroom. If they make $600,000 in net income for the year, and they have to pay $100,000 in preferred dividends, well, they're left with $500,000 for the common shareholders. If they average 250,000 shares outstanding over the year, you just divide that $500,000 by 250,000. Their EPS is a solid $2 per share.
But hey, let's step out of the hypothetical bathroom and look at a real-world titan like Walmart. They sell pretty much everything you could ever imagine, including, as one of our sources humorously points out, poop emoji cake pans and bacon-scented mustaches. Let's see how their massive numbers translate to this formula.
Looking at their 2021 income statement, it is literally the exact same process, just with a whole lot more commas. We take their $13.7 billion net income. Now, since they don't have preferred dividends here, we just subtract $196 million of what's called non-controlling interest. And that gets us an adjusted numerator of $13.51 billion. Then, we simply divide that by their weighted average of 2.831 billion shares.
And boom, that brilliantly illustrates how we land on Walmart's official basic EPS of $4.77 for that year. All those billions of dollars seamlessly boil down to a metric that easily fits right in your pocket.
Section 3. Peeling the layers.
Because let's face it, reality is rarely just basic, which brings us to the variations you're inevitably going to encounter out there. When you look up a stock, you'll almost always see 2 distinct numbers reported. Basic EPS is what we just calculated together. It's just for right now, based only on current shares. But diluted EPS? That's a much more conservative what-if scenario. It's there to warn you about what happens if employees exercise all their stock options, or if convertible bonds are suddenly turned into shares. If those new shares hit the market, the profit pool is diluted among way more people, which means the earnings per share drops. And then there's the element of time. You've got to distinguish between what already happened and what might happen. Trailing EPS is a hard, indisputable fact. It's based on the actual reported profits from the past 12 months. Forward EPS, on the other hand, is basically an educated guess. It's based entirely on analysts' expectations and projections for what the company is going to earn next year. High-growth stocks actually often trade based on their forward EPS, simply because investors are paying for future potential, not just past performance.
Section 4. The buyback illusion.
All right, this is where things get truly fascinating.
Let's uncover a bit of an accounting magic trick. An academic study out of Amity University examined companies listed on the National Stock Exchange of India. The researchers specifically wanted to know if companies were using share buybacks, which, by the way, is just when a company repurchases its own stock from the open market, if they were using those buybacks specifically to manipulate their EPS metric.
The strategy here is just surprisingly simple. As this quote perfectly summarizes, a buyback creates a pure accounting effect. Think back to that formula we just learned. If an executive goes out and buys back their own company's stock, they are artificially shrinking the denominator. The net income, the actual cash the business made, remains completely unaffected. But because there are fewer shares dividing up that same profit, the EPS mathematically rises.
And the researchers ran paired t-tests on the data, and their statistical tests showed this isn't just a wild theory, it is a proven management strategy. After a buyback, the EPS of the sample companies showed a statistically significant increase. What this means in plain English is that executives can easily hit their financial benchmarks, impress Wall Street, and secure their own massive bonuses by magnifying their operating profit on paper, even if the actual core business didn't grow a single cent. Crazy, right?
Section 5. The Negative Earnings Paradox.
Finally, let's totally flip the script on everything we've talked about so far. Up to this point, we've treated positive earnings as the absolute holy grail. A higher EPS means more profit, so you would naturally assume a negative EPS, meaning the company is spending way more than it makes, means the company is totally doomed, right? I mean, why would anyone ever invest in a company with a negative EPS?
Actually, no, because as these points from our sources reveal, a negative EPS is incredibly common, and sometimes it's exactly what you want to see. Think about high-growth tech or biotech startups. They are often intentionally spending massive amounts of cash on research, development, and just aggressive expansion. They are capturing market share today so they can turn a huge profit tomorrow. You also might see fully established companies post negative EPS temporarily due to a broad economic recession, or maybe because they're absorbing the massive one-time costs of acquiring a major competitor.
So what's the big takeaway for you as an investor? Basically, EPS is just one single piece of a giant puzzle. A negative number shouldn't trigger immediate panic. Rather, it should activate your inner detective. You really have to ask yourself, is this company bleeding cash because their product is failing, or are they strategically operating at a loss to absolutely dominate an innovative new industry? You have to look way past the EPS to their debt, their cash flow, and their long-term management strategy.
So as we wrap up this explainer, I'm going to leave you with a question to chew on the next time you're ready to invest. When you pull up that financial snapshot and you see a glowing earnings per share number, are you going to take it at face value? Or are you going to peel back the layers, check for the buyback illusion, look for potential stock dilution, and find out what is actually driving that profitability? Thanks so much for joining me, and as always, keep questioning the numbers.